Good day and welcome to Q4 FY2024 earnings call of MPS Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Arora, Chairman, CEO. Thank you, and over to you, Mr. Arora.
Thank you, Ranju. Good morning from New York and a warm welcome to our Q4 and FY24 earnings call. Today on the call I have with me Sunit Malhotra, CFO of MPS Limited, Sukhwant Singh, Chief Operating Officer India of our scholarly practice, Tony Alves, SVP and Head of Product Management at Highwire, which is our platforms business, Kelly Lake, Chief Strategy and Innovation Officer at EI. Sukhwant and Sunit join us from our corporate office in Noida, and Kelly and Tony join us from the greater Boston area. Sunit will kick things off in our opening segment today by discussing our financial performance. Then Sukhwant will update us on our content solutions business. Kelly will then update everyone on the developments in our e-learning business. Tony will then follow up on the progress made in our platform business. Finally, I will provide an update on our progress on AI/ML, acquisitions, capital allocation, and summarize the outcomes of the board meetings. Let's get going. Over to you, Sunit.
Thanks, Rahul. On a quarterly basis, Q4 FY24 showed solid revenue growth. We recorded revenue of INR 150 crores on an FX-adjusted basis in Q4 FY24, which represented 17.5% YOY growth. While there was an EBITDA decline in this last quarter, that is expected to change quickly. On a full-year basis, MPS achieved a new milestone with FX-adjusted revenue of INR 546 crores in FY24. We broadly maintained our margins despite acquiring a loss-making business in AEE. Looking back at FY24, I would like to highlight 3 key strategic achievements. Number 1, our top 15 customers now contribute to less than 60% of our revenue, a much lower concentration than what we started this journey in 2012. All business segments and lines of business are developing growth momentum as we head into FY25. And positive development in operating cash flow allowed our board to recommend a generous distribution even in a year when we completed 2 acquisitions through internal accruals. I want to hand it over now to Sukhwant to discuss the development in our PS business.
Thank you, Sunit. So revenue in our content solutions business grew by almost 7.5% in financial year 24 compared to the last year. Given the business operating leverage, margins expanded on a standalone basis to 40% and were only lower on a consolidated basis due to the acquisition of AJE. The scholarly lines of the content solution business continue to lead the charge towards revenue growth and margin expansion. Volumes and revenues from our star customer base grew because our service delivery has been among the best in the supply chain as it has consolidated. In the scholarly marketplace, we have launched new capabilities linked to journal editorial office that are placed in a more strategic position in the value chain, which has not only resulted in a new business from net new customers, but also improved the stickiness and quality of our revenue with existing customers. Together with the Highwire suite of products and the newly acquired capabilities at AJE, this new JEO service compounds our capabilities and positions us as the only techno-service provider with a global market presence at the front end of the scholarly publishing value chain. Overall, the content solution momentum was held back only by a temporary blip in the education side of our content solution business, which is expected to correct in FY25. I continue to remain bullish about our content solution over the next 3 years, particularly in FY25, where we expect a level up. I want to hand it over now to Kelly to discuss the e-learning solutions performance in FY24. Over to you, Kelly.
Thank you, Sukhwant. E-learning continued as the second largest business segment. FX-adjusted revenues grew by 6% in FY24. And while we're behind our expectations in the scale-up of this business in FY24, I am confident about the profitable growth in FY25. This business has 4 operating entities: India, Germany, Switzerland, and Australia. All international subsidiaries succeeded in Q4 and FY24, scaling revenues at healthy margins. Our Indian entity had bumpy periods because of the deferment of a large project Rahul described in the last call. That impacted us in Q4 FY24, and we leave the bumpy period behind us as we enter into FY25 with a strong Q1. What gives me confidence about expanding our corporate learning business is the combination of newly developed internal momentum and the general pickup in the marketplace. Concerning the internal momentum, the subsidiaries in the e-learning business outside of India have gathered even further momentum in calendar year 2024. Our order book has expanded in the Indian entity, and the pipeline looks far more robust. Concerning the marketplace, we're seeing a lot more activity, and EI is getting much more attention. Our qualified leads and opportunities has picked up, for an example, and all the investments in the business seem to have had a compounding impact. Another example, just yesterday, a leading industry association called the e-learning industry recognized EI as the #1 global company in the market for leveraging our solutions to drive and maximize training ROI for our customers. I would now like to hand it over to Tony to discuss the platform solutions performance in FY24.
Thank you very much, Kelly. For the first time since the acquisition of Highwire in 2020, the platform business did not decline. Revenues grew modestly in FY24. Margins continued to improve due to a healthier customer profile, smarter cloud spending, and improved operational activity. On an FY basis, profits grew by as much as 30% in our platform business on a consolidated basis, including AJE. And the profitability position was even better on a standalone basis without AJE. Execution of product roadmaps was on schedule for the entire platform suite in FY24. The marketplace has received new features and functionalities, and there will be several monetization opportunities soon through the implementation projects and migration programs. We launched 2 new SaaS products, DigiCore Pro and Think 365, in FY24. We expect short-term revenue growth in H1 FY25 via customer migrations from older platforms and more remarkable growth from new customers from H2 FY25 onward. Please note that based on new information, I've advanced this growth timeline in the platform business by several months. I can confidently state that our platform business is now performing well in its newly achieved phase of healthy growth for the following reasons. 1, we're actively investing in product development. This includes new product launches, active product roadmaps, and resolution of
shaped our entry into Australia and New Zealand. Our second acquisition of a growing business was a refreshing change in how we operate. We had an opportunity to learn much about what it takes to operate and drive a corporate learning business, which largely differs from the other business interests. An alternate approach to investing, majority instead of 100% acquisition, also meant changing how we unlock value. The how concern Liberate is more about helping connect the dots for them across the different e-learning capabilities MPS has and supporting the management team from the corporate office on things such as shared services, including finance and legal. After a robust 2023, Liberate had a roaring start to 2024 and is expected to close its FI, which ends on June 30th, with a 25% growth in order book. To echo Kelly's comments earlier, the market opportunity in corporate learning is expanding, and we are uniquely positioned to acquire market share during this compelling point in time. In contrast, the acquisition of AJE, which was done in March 2024, has our leadership team more directly steering the business with proactive support from the AJE teams. We have already eliminated $12 million in annual operating expenses for AJE. AJE allows us to make a meaningful AI play, expand our reach into China, and most importantly, step up our strategic partnership with Springer Nature. The benefits significantly outweigh the near-term costs associated with temporary margin contraction from a strategic lens. And we're also expecting solid financial indicators, including a high ROCE. So AGE is an excellent segue into our progress on AI/ML. The advances in AI/ML have had a proportionate impact on the entire ecosystem, affecting our customers, competitors, the industry at large, as well as the macroeconomic environment. To spearhead this transformative opportunity, we launched a new initiative called MPS Labs in 2022, a pioneering initiative headquartered out of Bengaluru under our CTO. MPS Labs is our R&D division that powers innovation for the company and is also the incubator of new products, some of which were described by Tony in his remarks. MPS Labs is working on scaling and executing bleeding-edge tech. Key features include modular architecture, API-based integration, a microservices approach, and leveraging AI/ML on the cloud to design and develop innovative solutions. This 200-plus team, including developers, ML engineers, and data scientists, have made substantive progress in FY24. The scope of projects that have gone live include content profiling, automated and guided editing, content structuring, automated generation of supplementary content including abstracts, summaries, and assessments, image forensics, and ML-powered accessibility solutions and AI-powered translation services. The acquisition of AGE has further elevated our progress in AI, capacity, as well as our market positioning. All these initiatives are now resulting in new revenue for MPS. On capital allocation, our priority is always to redistribute surplus funds to the shareholders of MPS, provided there is no imminent use for those funds over the next 6 to 12 months. This approach allows us to stay focused, disciplined, and responsible. I'm pleased to share that based on the unprecedented earnings and operating cash flows in FY25, the Board of Directors recommends a final dividend of INR 45 per equity share of INR 10 for each the company. The final distribution takes the total distribution to INR 75 per equity share of INR 10 each of the company. Our board has taken a balanced view on return to shareholders. Overall, our newfound openness to debt allows us to keep up the consistent distributions, go ahead and acquire healthy and growing assets, albeit at compelling valuations, and significantly enhance shareholder value. Looking back at FY24, we experienced a mix of successes as well as challenges, and the scorecard does not reveal the excellent momentum we've achieved at the end of the year. This was our first year where we completed 2 acquisitions, yet our final dividend equates to a distribution in the FY a notch higher than the PAT that we achieved. Given our momentum and the yet to be unlocked value from the 2 acquisitions we completed in FY24, we are optimistic about FY25. There is so much growth potential, and we're comfortable forecasting at least a 25% year-on-year growth in PAT earnings in FY25. Let's now open the call to questions.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. A reminder to all the participants, please restrict yourself to 2 questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Karan, an individual investor. Please go ahead. Mr. Karan, please go ahead with your question.
Yeah, can you hear me? Hello?
Mr. Karan?
Yeah, we can hear you.
Can you hear me? Hello?
Yes, we can hear you, Karan.
Okay. So I have one question. So we have basically a new strategy, like we are planning to make acquisitions 2 every year, right? So I have one question to ask regarding this strategy. So how do you, make sure, like the companies which you are acquiring, so they does not lose the clients and the employees, right? And so basically there is a cultural shift when a company got acquired by a parent company, right? So how do you see, like we are solving these challenges?
Sure. Thank you for your question. I don't think we have changed our strategy to do 2 acquisitions every year. We did 2 acquisitions in FY24. Having said that, we do have a modified acquisition playbook, as you rightly pointed out, Karan. So, and the change in approach is we're looking at larger bites. So, like with AJE, north of $20 million in revenue. We're also looking at companies that come with some inherent strength, even if they are not super, high on margins upfront. Our goal is that we should have solid line of visibility that we can get them to the MPS level very quickly, rather than later. And in terms of your question on how do we make sure that these acquisitions don't implode, I think the biggest change has been that we're looking at a different type of assets now. So historically, we've been an acquirer of distressed assets. We're now looking at healthy assets, businesses that have momentum already before we acquire them. Additionally, it is a small community. We operate in 3 markets: scholarly, education, and corporate. So we tend to, acquire businesses that we already somewhat know. Also, during the diligence process, we tend to not only do financial, tax and legal diligence, but also HR diligence from a perspective of cultural alignment and values alignment. We have walked away from some very attractive opportunities in FY24 simply because the last piece of it, the values alignment, was not there. So obviously, you can never get it perfect. We've had a decent track record, and a large reason for that has been how disciplined we've been in our approach. So the parameters that we look at are the company should have momentum in terms of growth and profitability. It should be a premium asset. So number 1, number 2 in its space, even if it's in a niche space, it should be operating as a premium company. The third piece of it is, customers should be sticky. So revenue should be sticky. The fourth, of course, is limited churn in the employee base. And the fifth, which is the most important element, is cultural and values alignment with MPS. So like I said, obviously you can't have a foolproof approach, but the way we attack it is we make sure that we're super disciplined and responsible in making sure that we don't deviate on any of the parameters I described.
Okay, thanks. I have one more question. So we are giving a guidance of tripling our top line by 27, right? And in your earlier presentations, you have mentioned there is a scope of margin expansion as well. So what do you think? Can you give some guidance about the margin expansion also by 27 or 28, like you are giving in terms of the top line?
Yes. So, this year, FY25, like I pointed out earlier, we're projecting a 25% year-on-year earnings, and that kind of brings us, as you rightly pointed out, back on track towards Vision 2027, which is an FY28 goal. On earnings, I think on margins, the only part of our business that currently is underperforming on margins is the e-learning business. Our goal is to get that business in the short term to a 25% margin, and more on a 2-year term to a 30% margin. In fact, FY25, we're expecting a pretty big catch up on the e-learning margin. So broadly, I think we can expect with that change, given that it's a smaller proportion of the business now, you can expect a 2 to 3% improvement in margins. And of course, depending on how the content and the platform business scales and how quickly it scales, there will be some margin appreciation there. But overall, I would say from a margin profile perspective on a consolidated level, we should look at 2 to 3% and really focus on the CAGR on the revenue.
Thank you. Mr. Karan, please rejoin the queue for more questions. Next question comes from the line of Rahul Jain from Dolat Capital. Please go ahead. Mr. Jain, please go ahead with your question. Mr. Jain, if you have unmuted from your end, please go ahead with your question. Mr. Jain, please go ahead with your question. Since there is no reply from the line of Mr. Jain, we'll promote the next in line. That is Mr. Mahesh, an individual investor. Please go ahead.
Hi, can you hear me?
Yes, we can hear you.
Rahul, my question is on the impact of AI on the ecosystem. What is the impact of development in the AI ecosystem on your customers in each of the verticals that you operate? To what extent it is disrupting their own business models, and what is the impact of all this on your order book?
Sure. Thanks, Mahesh. That's an excellent question. So I'll divide this into short term and medium term. I think in terms of customer profiles, we have three types of customers in terms of how they are thinking about AI. We have customers that are cautiously optimistic. We have customers that are saying, we don't want to be the first. So we want to do something, but we don't want to be the first. And then we have a third category of customers, which is the smallest category, which is saying, we're just not going to ignore this whole thing. That's a very small part of the customer base, but yes, there is that customer base too. Short term, we are actually seeing a positive opportunity in terms of revenue growth. I think a large part of our customer base is trying to basically enable AI in their workflows. They need strong partners to in order to do that for them. So areas where we have seen that is translation, for example, where has been a soft area for revenue for us, but in translation services, AI-powered workflows are becoming very common. Similarly, on accessibility, how you're making content more accessible, you're generating some of the alternative text very seamlessly through machine learning, as well as generating supplementary content through existing products. So short term, we've actually seen significant opportunities on the revenue side. We expect that to continue into FY25 as well. This will, of course, be accretive to both the content business as well as the e-learning business in terms of short term. Medium term, I think what we anticipate is once these AI workflows are enabled, and then the second piece, Mahesh, is more opinion. It's not data driven; it's an opinion. Is that we will probably see a final consolidation of the supply chain, and the reason for that is when you're in some of these AI workflows, a large part of what you're doing, the value is unlocked through iterations and time. And for a customer to, for example, if you're opening up, if you're building a proprietary LLM for them, they obviously can't build that LLM out with 4 or 5 suppliers, right? Ideally, they want to build that with one. Worst case, they want to build that with 2 to make sure that they have some diversity. So I think more longer term, what we're going to see is, a consolidation of the supply chain where customers that today work with 5, 6 vendors on the content side and on the e-learning side with 10, 12 vendors, they will kind of be forced to work with 1 or 2. I think time will tell how that affects MPS. Of course, we're going to try our best to make sure that we are one of those 1 or 2 vendors that work with our core customer base. But I think we're going to see change in how customers engage with the vendors because there will be this mutual codependence. We are very confident based on the approach and as well as the strategy that we've seen so far from our customers that they want to co-develop this and not do it in isolation because a lot of the capabilities actually sit on the vendor side. I think scale players like MPS should see an opportunity, but of course, where We'll probably see that with our core customer base. And, it's possible that we may lose some revenue in the long term with customers that are transactional, because they'll want to go deeper with their core customers. So yeah, I think short term, good revenue growth because everyone's piloting a bunch of things. They need partners to implement these projects. Medium term, 2 to 3 years, I think there will be a final consolidation of the supply chain, which, it's high time it does happen. Our total TAM is over $300 billion, and the largest company in our space is 300 million. So, this supply chain is ripe for consolidation, and if AI can do that, I think we all for it as MPS. So we're looking at it as a positive. Yes, there'll be, how we do business will change. Who our customers are might change. We may not be servicing 750 customers for 3 years from now. But overall, we're optimistic, and we're making a lot of investments to make sure that when those customers do take that call, that we're only going to work with one or two providers. MPS is in the short list, as well as the next 2 or 3 years as they're piloting things with us. We are doing our best to make sure that we are ahead of our competition on whatever we're doing.
Thanks. Very interesting, guys. So you mentioned LLM capabilities. So I would like to know if MPS investing enough, to be at the forefront of providing LLM architecture to your clients or customers?
Yeah, I think we were at a certain level, which was pretty impressive, ahead of the market. I think overall, as MPS Labs, we of course have developed our own, and we had fed about 300,000 unique documents to our model. And then after AGE, it's gone to a whole new level because they also have 2 models. One has been fed by over 1 million manuscripts. Another, which is the back end of Curie, has been fed 250,000 documents. So we've gone to a place where we were doing very well, and we thought that we were ahead of the marketplace. But with AGE now, we're at a whole new level. And that's where, we're seeing a lot of opportunity in the near term for AGE, because a large part of AGE today, in fact, almost all of it is B2C, which is, working with authors directly. But we're seeing a tremendous opportunity for AGE on the B2B side to service the MPS core customer base, which of course we have strong relationships with. We've done some excellent demos. We'll talk about pilots and projects as well.
Thank you. Mr. Mahesh, please rejoin the queue for more questions. Next question comes from the line of Vikas Mistry from Moonshot Ventures. Please go ahead. Mr. Mistry, please go ahead with the question.
Hello.
Hi, we can hear you, Vikas.
Okay. Thanks for the opportunity. Rahul, I have a couple of questions. The first is on AI part. There are very large language models run by these companies like Perplexity.ai. They are injecting and going through so many manuscripts. What really gives you confidence that you will be in pole position and these people will not fine-tune their models on this large market of you enumerated of 300 billion? So what gives you confidence to be in pole position and these large language models will not disrupt your space?
Yeah, I think so. Some of the ones that you described are more mass. What we're developing is very specific and niche to our industry. Please know, within MPS, we are the oldest provider in terms of, on the publishing side. We are the oldest provider. That's over 50 years. We are the oldest provider on the corporate. So that was from MPS Macmillan. We are the oldest provider on the e-learning side through Tata Interactive, and we are the oldest provider on the platform side through Highwire Press. So the amount of expertise as well as legacy data that we possess is unparalleled. And of course, I'm only talking about our use case of the 3 markets that we operate in, which is scholarly, education, and corporate learning. But of course, we're not trying to compete with the mass models that are being developed. our models are more focused on each of these markets, and at a customer level, we're also building them at a customer level, because in our industry, there's a massive concern around data and IP. In order to protect that concern, we're having to custom develop that at a customer level.
Yeah, thanks. Okay. My next question is acquisition. What white spaces do you see still now on those three verticals we operate, and where we're trying to get more acquisitions? Because I think we have full bouquet products now. The only thing is that we have to scale up. And you contradicting to that, you are saying that we still can go for more acquisitions on whether they will be bolt-on acquisitions or whether they will be in same area just to ramp up the scale.
Yeah, thank you for that question. Again, excellent question. So yeah, I would not say from a capability standpoint, yes, we do possess quite a bit. Having said that, there is still opportunities for capability expansion that allow us to move up and down the value chain. So we're looking at those type of opportunities. We're looking at opportunities that expand our geographic reach as well. So for example, last financial year FY2024, we expanded into Australia, New Zealand, as well as in China. There are still regions like the Middle East, as well as Latin America, that we're not currently very strong in. Also certain parts of Europe where we're not very strong in. So there's a geographic play that we're looking at as well. And finally, the piece that we are again looking to actively accelerate is the education space. Today in the education space, a bulk of our revenue comes from K through 12, as well as through publishing, and our goal then is to scale that into higher ed, and specifically within higher ed with adult learning and education institutes. So there's still much juice left for us to acquire in terms of capability expansion, geographic expansion, as well as adjacent market expansion. So we're looking at all three vectors. And there's still a lot of juice left on the acquisition side.
Thank you. Mr. Mistry, please rejoin the queue for more questions. Next question comes from the line of Tarshil Jhaveri with Crown Capital. Please go ahead.
Hello. Congratulations on a great set of results. Hope I'm audible. Hello.
Yes, you are. Thank you.
Yeah. Hi, sir. So just wanted to understand now. So we are in terms of our growth projection that we are seeing maybe for next year. So we are planning around a 25% earning growth. So our revenue would be growing a bit less than 20%, as we would also be having a margin expansion. So what kind of a revenue guidance do we see for next year, sir?
I'd be slightly uncomfortable giving a revenue guidance. But we like to report one number, so that number is going to be 25% PAT. I think short term, probably our revenue growth will be higher than our profitability growth, simply because we acquired a loss-making AJE. A bunch of that has already been culled in terms of expenses, but still it's not. Every quarter we'll see margin improvement in AJE. So as a result, in the short term, we will be out of sync on revenue growth and profit growth, and revenue growth will be higher than profit growth in the short term. But overall guidance for the year is 25%. That's it.
Okay. That helps a lot, sir. And EBITDA, we are seeing that we will have a 200-300 basis points improvement. That is something that we are confident on, sir.
Yeah, I think largely PAT, EBITDA, they all tend to flow in the same proportion. I like to look at PAT because that's kind of the bottom line, and it culls all the noise. So I like to look at that. That's more a personal thing. Otherwise, they all flow in the same proportion.
Thank you. Mr. Jhaveri, please rejoin the queue for more questions. Next question comes from the line of Krushi Parekh from Pentacle Family Office. Please go ahead.
Yeah, hi Rahul. I think some of the questions on the strategy side have been answered. Just one question, what are the challenges that we are facing, especially in the North American and maybe even in the European markets these days?
No, I don't think we're facing any challenges. I think that the big challenge, at least we are not anticipating. We have not seen anything in FY24. First couple of quarters, so normally you can look into the next 6 months. FY25 as well, we're not seeing any challenges. Now, of course, if that changes in the later half of the second half of the calendar year, then we'll have to wait and watch. But no noise as of now. The only challenge that we face, which is more FY24 focus, was very unique to us, which was we had this massive order for building an experience center, which would have meant that our e-learning business would have grown at around 15%. Additionally, profit growth would have been slightly higher for that business. Of course, that didn't happen. So therefore, it was a disappointing quarter and a disappointing year for the e-learning business. But again, like as Kelly pointed out, FY25 looks super strong, and we're very excited about the e-learning business making a comeback. So yeah, not seeing any challenges. Maybe I'll just bring Kelly in to talk a little bit about how the market is developing in North America as well as Europe, because I know she's heading that effort for us on the corporate side. So maybe she can give some commentary on how she's seeing both those markets for corporate learning in the next year or so. Kelly?
Thank you, Rahul. So we are actually in a very pinnacle part of the market right now with a very positive upswing for possibilities within North America and Europe. We are focusing on our global footprint expansion. We're seeing growth rates being produced from North America substantially this year, as well as the European countries as well, due to organizations looking for strategic partners such as ourselves to help them drive performance improvements across the board. So those opportunities are tying, learning initiatives back to the business and ensuring that the company is being good from a productivity and a profitability perspective. So we're seeing growth substantially in those core areas over last year, and we will continue to see that move forward as the economic situations improve. Also, they're looking for introducing new verticals, and we're able to provide strategic solutions because we are a strategic partner providing a unique set of solutions that our competitors are not. So that market is opening greatly for us, and we will definitely see substantial growth within those core areas. Thank you.
So if I can supplement what Kelly said, sorry about that. Just to supplement what Kelly said, I think, yes, we understand where you might be coming from in terms of looking at the global ITS market, and maybe that's why you're asking that question. So two things there. One, we're not exactly ITS. That's a different space altogether. And second, happy to humbly say that we're not that big. So there's a small base effect. Last year we did about 550 crores in revenue. So I don't think we're there yet in terms of size and scale to have the kind of headwind some of the larger companies are facing, probably. So again, that's more opinion.
Right. That's good to hear. If I can just ask one more follow-up question on this.
Sure.
So when we are looking at the market, the expansion of our business, is it more to do with us consolidating the market and capturing the existing market, or even the overall market is growing?
Yeah. So, again, we operate in three markets: scholarly, education, and corporate. The scholarly market basically grows at 6% every year. It doesn't grow higher, it doesn't grow lower. Even during recession, it grows. So in that market, it's more share of wallet expansion, and we're doing that through being an end-to-end provider in the value chain. And then on the education side, the market itself is expanding, and we're also trying to capture market share. And on the corporate side as well, the market itself is growing, and we're trying to capture market share. So with the exception, scholarly is probably the only exception to that rule. But for education and corporate, it's both. It's market share expansion as well as the market expanding at over 10%. I'd like to bring Tony in for a minute because he can talk a little bit about what's so different and compelling about MPS as a company, that even in a scholarly market that's not growing with more than 5-6%, we are actually growing at 15-16%. So what is different about us that we're being able to capture more market share in this market? So Tony, if you could just help everyone understand that even in a slow growth market, we seem to be outperforming everybody else. Why is that?
Sure thing. Thanks, Rahul. Well, MPS and Highwire, we're the only independent organization that really offers the full end-to-end solution for scholarly publishers. And with the acquisition of AJE, we have solutions for manuscript preparation. We have, of course, workflow management tools, content hosting, business analytics, and so MPS really provides we provide really robust modern software, and that is also complemented by what is really a very highly skilled staff that understands the domain and that understands the unique way that scholarly content needs to be managed, how scholarly content needs to be edited and presented. Our major competitors in this space, as has been mentioned, they're owned by large commercial publishers. That means that really MPS is a true publisher independent provider. So that's a really important differentiator. Many of the society publishers, large and small, as well as university presses and other commercial publishers, they want platforms and services from an independent source, not from their competition. Also, MPS, we're not weighed down by legacy systems that are built on old 25-year-old technology. We are actively building and delivering new systems. Those are based on modern modular architecture that utilize AI, natural language processing, microservices, and that means that these solutions are easy to enhance and upgrade. So within the scholarly marketplace, we really have an advantage and a lot of opportunity to grow our business in a slow growing sector.
Thanks, Tony.
You, or I'm happy to comment on anything else that you think would be helpful.
No, thanks, Tony. Thank you so much.
Thank you. Mr. Parekh, please rejoin the queue for more questions. Next question comes from the line of Rahul Jain from Dolat Capital. Please go ahead.
Hi, I hope I'm audible this time.
Yes, Rahul, you're audible.
Yeah, thanks for giving me the opportunity again. So, essentially my questions are two. Firstly, just about around 2 months we are into this transaction. So any hit and miss if you identify in terms of your experience versus at the time of the transaction that you might have noticed, any positive or negative surprise. Secondly, on the organic business, it would be great if you could explain what's your view from a 1 to 3 year perspective, and especially on the e-learning side where probably organically the scalability has not happened while the industry continues to offer tremendous opportunity. Do we need to expand our offerings in that space? Thank you.
Sure. Thanks, Rahul, for those questions. Yeah, I think with the acquisition of AJE, there's obviously, from an outcome perspective, no surprises. So, like I pointed out at the beginning of the call, during the diligence phase, we had already figured out that this is going to be, from a cost management standpoint, it's going to be a beast. And the team has very successfully delivered on unlocking that piece. So yeah, a lot of detailing and a lot more work than we expected on the cost management part, but we have eliminated, as I explained already, $12 million in annual operating expenses. So a lot of those will not show up in FY24. They start to show up from Q1 of FY25. So that is more forward effect that we have not seen yet. AJE was loss making in Q4 FY24. So no change in outcomes. It was a lot more work than we expected, but it's all behind us now. Or most of it is behind us now. And then I think the positive that we did not expect. So we did expect, strong B2B integration on the scholarly side. So, we started to see some of that. We are already pitching AJE services as well as the Curie platform to scholarly publishers. So, that was an obvious integration. And we're starting to see the revenue synergy start to unlock as some of our customers start to get super interested with AJE and Curie. The positive piece that we did not anticipate was more on the education side. We've historically, we and AJE have thought of themselves as kind of this, company that, is focused on the scholarly market. But we've seen, in the last couple of weeks, through roadshows and demos, what we're seeing is there's a lot of interest in Curie on the education side of our business. We're also seeing, that it has elevated how people think of us in the marketplace. We've been talking about MPS labs and AI now since 2022, but after the acquisition, it's, the perception and has gone to a whole new level. And finally, something that we probably should have figured out during diligence, again, a positive, but probably something we should have figured out during diligence was we can actually use, these tools in our own internal efficiency goals. So that's something that we are now starting to look at in terms of integrating with Curie and other ABA offerings in our content solutions workflow. So that should hopefully in the medium term help improve margins even more on the content side. So yeah, so three big positives, not really a negative, but more that it was a lot of work, more work than we anticipated. But yeah, it's all done now. So most of it is done now. So very, very happy that we went ahead and, took this call. I think it was a larger bite than what we typically do, in terms of, an acquisition. So, but yeah, I think, definitely a good decision. On the organic side, I think, on the content side of our business, really the scholarly business has just been has seen some phenomenal growth. Again, to what Tony was saying, it's a slow growth market, but even in that market, we're growing in double digits. So, really what we need to now do is make sure that we're creating the same momentum in the education side of our business. So I don't think there's a capability issue. It has been more, an internal, go-to-market strategy kind of issue. So we've corrected the GTM on education now, and we're already starting to see, solid results from that. Education business should be strong within the content segment in FY25. With respect to e-learning, again, the market is growing. All the international subsidiaries, TopSim, MPS Europa, Liberate, they're all growing in double digits. They're all doing really well. I think we won a very large order back in September of 2023. And, the focus was A, on winning that order, and B, then executing that order. I think the team may have taken their foot off the pedal a little bit because it was in the bag and the focus was on that. And once that project did not transpire, it set us back by 6 months. And I think that's just what it is. It's a 6-month setback. It's behind us. And we've just now gone back since January. We just hit the market hard, which, as Kelly described, our pipeline has improved, our order book has improved. All the lead indicators going into FY25 around revenue and e-learning are looking super strong. So yeah, I think now it's more about delivering on the projects that we have won and converting the opportunities that are in the pipeline. So yes, on the organic side, change in GTM strategy for education and tightening up things a little bit on the corporate learning side. I think those have been two subtle changes we've made. And I think growing pains, right, in any business when you're trying to grow at a 25% CAGR between organic and inorganic, every once in a while, you'll have a spill. But not, I'm not overtly concerned because overall on a 3-year timeline we're trending the way we need to. So yes, would have been happier if we didn't have this small bump in the last 6 months. But yeah, it's more important that if you do something wrong once, you pick up very quickly, and I think the team has done an excellent job of recovering very quickly.
Appreciate it. Thanks a lot.
Thank you.
Thank you. Next question comes from the line of Naveen Botra, an individual investor. Please go ahead.
Yeah. Good evening, sir. Congratulations for a stable set of numbers and excellent distribution of around 5% of our overall market cap and completely giving back the earnings to the shareholders. So my questions regarding AJ had been already replied by you. So I would like to restrict to about the Maginu vertical, in the e-learning vertical. In the last quarter, we said that we have one of the large experience center project of a PSU oil company has been deferred, and your commentary was that we may be in a position to say something about this deferred project. So if you can throw some more light on that project and the overall Maginu Studio vertical, this augmented reality, virtual reality, if you can throw more light and the roadmap journey ahead, it will be quite helpful, sir.
Yeah, thank you for that excellent question. Overall, on the stalled project, unfortunately, I have nothing new to report. Hopefully, that changes at some point. Having said that, we have already on that particular project, we've already replaced that project with an opportunity for in FY25. So we're not really concerned about that. If that project comes, great. It'll be like Diwali for later in the year. But even without that project, we're feeling very confident because we've replaced that with a different opportunity. So that's what I was trying to explain to Rahul in the previous question, that the team has done an excellent job to recover. So we've replaced that with a different opportunity, and overall, we have won a series of projects on the virtual reality and the AR side with our core customer base in the last 3 to 6 months, as well as we acquired a couple of new logos because of our capabilities in immersive learning. So again, FY25, watch this space. It's, of course, on the e-learning side, it's looking like a very strong year for us after a modest FY24. Both in terms of the financial indicators, so revenue growth, profit growth, but also most strategic indicators. We are in the running for a couple of awards in this space. So hopefully we find out in August. We already filled in the application, but August we'll find out if we actually won those awards as well. And these awards, if you win them, it kind of gives you strong recognition in the marketplace. So yeah, we're up in the running for a few. So also fingers crossed on that.
So when we talk about this housing, this vertical under e-learning space, how do you see this Maginu vertical spinning out in, say, next 2 to 3 years? Will it become a independent this vertical out of e-learning space, or it will be housed under the e-learning space regularly? So giving the numbers separately, when it will be possible, sir? Because it's a very interesting vertical. We see it is a very scalable thing and all differentiable thing for MPS.
No, absolutely agree with you. In terms of business opportunity, I have zero objection to what you're saying. The scale up that we see in the space, the scale up opportunity that we see in this place, is massive. Having said that, the reason we at this point don't want to, unlock this team from the rest of the business is simply because of the operational efficiency and the margin improvement we see by keeping these two businesses whole. Because what tends to happen is, this experience center and Maginu vertical, it tends to be very choppy in terms of the order inflow. So you'll have one quarter where you get this massive project and you have to execute it, and then the team will be sitting, empty for the next 6-9 months. So we see more value in keeping them whole. For more operational reasons. One is, like I explained to you, more on capacity management. The second piece, of course, is when we introduce, this talent into some of the traditional e-learning side, it helps us distinguish ourselves from the competition, because this team then comes in with a far more creative approach to the solution that we're proposing, and that brings us a notch higher. So from a business standpoint, yes, from a financial standpoint, yes, at a high level, as we scale up, MaginU will only become a larger proportion of the e-learning business segment. But from an operational efficiency standpoint, there's a lot of value in keeping it whole.
Thank you. Mr. Bothra, please rejoin the queue for more questions. Next question comes from the line of Keshav Garg with Counter-Cyclical PMS. Please go ahead.
Sir, I'm trying to understand that in our consolidated balance sheet, there is a tremendous increase in intangible assets under development from less than 31 crore to over 93 crore. So if you could help us understand that what is the total increase in intangible assets is around 63 crore year on year. So why are we firstly, instead of debiting it from the P&L, why are we capitalizing these expenses? And what are these pertaining to?
These are to the acquisition of AJE.
So, but then if you see, then goodwill has increased from 123 to almost 270 crore, which is an increase of 120 crore, which is what we paid to acquire both the acquisitions that we did last year. So then how come, when it is already covered in goodwill, then how come it is again being accounted for under intangible assets?
I'll let Sumit come in and answer that question, but my understanding is it is all got to do with the AJE acquisition. But Sumit, you can come in and describe what's happened.
Yeah, thanks, Rahul. So this is for both the acquisitions. This is for AJE as well as Liberate. So just to answer this question, based on purchase price allocation, certain amounts which can be identified and which can be allocated to the tangible assets and intangible assets, those are debited there, and it is only the balance amount which is to goodwill. So not the entire amount which goes to the goodwill. So in this case, the goodwill which has increased is basically because of Liberate and AJE both. Liberate is 43 crores, and in case of AJE, it is close to 100 crores, which has increased the goodwill. And when we look at the other intangibles, in fact, that has also increased. So in case of this increase is 62.5 crores, and which is basically 40 crores is because of Liberate, and the balance is coming from AJE. So this is for the trade.
Mr. Garg, I think. Mr. Garg, the answer to your question lies in your purchase price for what you're looking at AJE is probably lower than what you're calculating. So I think that's the variance that you're getting. But it's totally got to do with the acquisition. So maybe you're working off an incorrect purchase price, because I think the effective purchase price is higher than what you're probably looking at.
Yes, thanks, Rahul. In fact, that's the.
Thank you. Mr. Garg, please rejoin the queue for more questions. Next question comes from the line of Guneet Singh with CCIPL. Please go ahead. Mr. Singh, please go ahead with your question.
Am I audible?
Yes, you are.
Yeah. Hi, sir. So, you have mentioned that we would be expecting about 25% growth in PAT this year. So are there any downside risks or contingencies on that? Because last year we had given a guidance, but one of our contracts was 40 CR and e-learning was deferred from last year to this year. So, I mean, are there any contingencies or downward risks that we're looking at for achieving the 25% growth? And also, please update about the deferred project also. Would that be completed this year?
Thank you for your question. Yes, I think so. I don't have an update on the. Unfortunately, I don't have an update on the deferred project. It still stands deferred. We have no update from the customer. Like I was pointing out in a previous question, that project has been replaced by the team with a different project, so we're feeling quite comfortable. Yeah, I think overall, we usually share this guidance after Q2. There was, a lot of encouragement to share this guidance sooner, and so we have. Of course, we feel very comfortable at this point that this is a strong guidance. Having said that, I won't be silly in saying that it's 100%, success kind of situation, but we feel quite comfortable that this is, a comfortable guidance that we provided. At this point, we don't see any significant downside to what we've shared. We have some headroom in this guidance, and accordingly, we've given the guidance that we're comfortable with.
All right, sir. With respect to the acquisitions, we made this deliberate acquisition, but the e-learning revenues are up just marginally. What is the reason for that? And in terms of AJ acquisition that we made, the margins, the margins were in low teens, but you mentioned that it was loss-making. So can you share some light on that? And by when will we start consolidating that in the balance sheet and the profit and loss statement, AJ revenues?
Yeah, I think on the e-learning side, as I was pointing out in the previous question, if we had executed the order that we had in hand, we would have grown at 15%, not at 15% at FY24, and even higher in revenue terms, and even higher on profit terms, because it was a high margin project as well. So that was a setback that we've had. It's in the rearview mirror, and we're now focusing on FY25 on the e-learning side. On AJE, we have in FY24 consolidated 1 month of financials, which is March. It was a loss-making month. We've eliminated a significant portion of what we needed to eliminate to make the business reasonably profitable. So we expect to report that in Q1, and of course, every quarter through the end of the year, the margin profile of AJE will only improve. AJE is getting consolidated in our content business as well as our platform business, because there's a content piece which is the language editing and author solutions piece, and then there's of course software as well as services around the software. So from an operations perspective, integration has run very efficiently, and we've already started to integrate operations.
Thank you. Mr. Singh, please rejoin the queue for more questions. Next question comes from the line of Navid Virani with Bastion Research. Please go ahead.
Hello, am I audible?
Yes, you are.
Yeah, so thank you for the opportunity. My first question is pertaining to the e-learning segment. So if I look at the headcount number, that is sequentially going down. So we were at close to 500 odd employees last year, same quarter, versus around 320 employees right now. So can you help us understand what is driving this change? Are we on to some strategic shift on the manpower side here?
So that's an excellent, very good observation. Yeah, our mindset around this, how to operate this business has significantly changed since the acquisition of Liberate. They do an excellent job of, managing their workforce. So they actually significantly, outsource or use contractors, because they've learned over the years that, because the inflow of work is so different in this space, and in generally in learning, there are so many gig workers that are mature and so many vendors that are available for us to work with that are super specialists. It's better to have an operating model where you have a permanent workforce, but you also have a very rich contractor pool and a vendor pool. So what we've done is essentially as we saw revenue revenue erosion in MPS Interactive, which is branded as EI Design, we've taken the opportunity to adjust our operating model, which basically means in-house we're going to have lesser people, and we're going to be contracting more and outsourcing more, which also will result in significant margin expansion. So it's a change in operating model that we have learned through the acquisition of Liberate. With every acquisition, you learn new things, and seeing them do this so successfully for the last decade, we've embraced that. And interestingly, in Switzerland as well as in Germany, we are already doing this. It was just the India entity that we were using a traditional approach, where we were trying to do everything in-house. And now we're taking a more balanced approach, where we are trying to use super specialists outside and only keeping the workforce that is required for recurring revenue inside.
Okay, thank you. Thank you for the detailed answer. Second one is on the historical activities of MPS. So if I look at the long-term history of the company, I can see that we have acquired companies at extremely lucrative valuations, and they have been proven to be great acquisitions for us. So firstly, wanted to understand what is that differentiating factor, which is helping us get acquisitions at such good valuations in a world which is, dominated by the venture capitalists, etc. So just want to get your sense on how are we able to do this?
I think the one-word answer is discipline. There are many more opportunities that we've walked away from in the last 12 years. So we've done 10 transactions in the last 12. We probably walked away from 100. So you're obviously only seeing the outcomes. But I think just to answer your question, we have a framework. We've modified it a little bit 2 years ago to make it even tighter. And I think the simple answer to that is we're just very disciplined.
Thank you. Mr. Virani, please rejoin the queue for more questions. Next question comes from the line of Janish Shah with Investment Professional. Please go ahead.
Yeah, thank you for giving me an opportunity. I just have one question. I think in the last business update calls for AJE, you mentioned that there is also one more acquisition which is lined up in FY2025, which should be around 6 to 8 months away. You can just give some roadmap to the acquisitions as to how these are going to come up in the current year, and given that you have already distributed handsome profits to the shareholders, and you are confident of funding these acquisitions in the future, could you just give some color or maybe a bit more detailed understanding on the roadmap ahead on these fronts? Thank you.
Thank you. Yes, you're absolutely right. When we were announcing the AJE acquisition, we had described that there's another one that's north of 20 million that we're working on. So that's still active. It's not something that has gotten derailed or anything. It's just that the timing of that is going to be closer to the end of this calendar year, and that is a result of a mutual understanding. The other party wanting to take some time with it, as well, because they have certain things that they're sorting out, as well as for us. We've done 2 acquisitions, Liberate as well as AJE. Even though Liberate, we're more of me and my team are playing more of a role of an advisory role and a support role. It's still work. And similarly with AJE, my management team and I am actually actively steering that ship. So there is no kind of shift in the likelihood of us doing an acquisition this financial year, FY25. It's just that we think that's going to happen more towards the close of this calendar year. Of course, it's not. We have that one opportunity that I described, and we also have others in the pipeline. But I think, given we've taken these bites in FY24, we'd like to have things settle down a little bit before taking the next bite, so that we make sure that we unlock the full value of the two acquisitions that we've done in FY24. In terms of, capital allocation, again, because, the business is, touchwood, a business that generates solid operating cash flow every month. By the time, the time comes to pay the purchase price for the next acquisition, we would have generated, a decent amount of cash during the period. And of course, when we were pursuing AJE, we met with a couple of banks and got pretty far along in terms of figuring out what is the quantity and of debt we can raise comfortably. And we were pleasantly surprised that there were many players out there outside the logistics pool that we engaged with that wanted to be part of the journey. So, I think it's a combination of the fact that an acquisition is more than likely to happen in the later part of the calendar year, as well as the openness to taking on some debt in the next one, and having tested waters on that. So this time we're not going in blind. We already tested waters on AJE. It's just that we ended up paying less than what we had imagined on AJE, so we backed off on the debt component. But I think for the next one, we're going to be more open to it now that we've tested the waters.
Okay. And just an additional question with regard to, I think you mentioned somewhere that you already reconfigured the matrix for the acquisitions a couple of years back. Given that in the last 2 years, again, the things have been changing or have changed quite dramatically in your space, do you think it needs a further recalibration, or like with every acquisition or with every deal which comes to you, what's your experience in terms of offering or maybe evaluating these kind of deals? Is it becoming more and more tougher, like I'm saying, more stringent, or if you can give some qualitative aspects to it? Thanks.
Yeah, I think our valuation approach remains the same. I think our ability to forecast, as well as in terms of what could be the potential upside or downside post acquisition. So when you create that DCF model, I think we're getting tighter on the model itself, which is then the assumptions are getting tighter, and therefore the framework is doing better. So the framework has not changed. It's just the assumptions going into the framework are improving with every acquisition. And the piece that we don't often talk about, but is probably more important, is we're getting tighter on integration. We figured out very quickly in diligence, what do we need to do in the diligence process itself. So our integration starts in the diligence phase. We don't wait for it to start once we own the company. So I think the part that's gotten the most efficient is less about capital allocation, but more about how do we integrate and how do we unlock value post acquisition.
Thank you. Mr. Shah, please rejoin the queue for more questions. Next question comes from the line of Arjun Balakrishna, an individual investor. Please go ahead.
Hey, hi Rahul, thanks for the opportunity. So the first question I have is, on AJE, so you have been saying that you would like to always, and going forward, you would like to acquire profitable businesses. But then AJE is not a profitable business, right now. You're turning it around. Are we going back on the model a bit for AJE?
Again, thank you for that excellent observation. Yeah, I think we had with the seller, we had arrangement that they could fix it for us and sell it to us, or we could take it on the way it is and pay a low price. And we went for the latter, which is we are the value type, and because we had a clear line of sight in terms of what needs to be done, so we're not really going back. We could have insisted that the seller does this for us, and it is a very, very easy path in terms of proper strategy execution. Of course, it's always difficult, but so the reason we chose was for us to do it rather than for them to do it was one, because we did the financial comparison, and of course the second option was a better option financially. And the second piece of this was, at the end of the day, the seller is Springer Nature, who is our largest customer. So we did earn brownie points through the process, which we're already trying to cash in as we try to grow our partnership with them on the content and platform side. So I think that additional level of detail I just provided will help you reconcile that it's not a change in approach. It's more to do with looking at it more strategically and financially, stepping back and saying, let's take on the short-term pain because the benefits outweigh the costs.
Understood. And the guidance of 25% on the bottom line, can you split it out between, because you're going to gain some on the AJE improvement throughout the year. So X of AJE, what's your guidance, or how do you predict the bottom line improving X of AJE?
Yeah, I'd like to stay away from that if that's okay. Would appreciate your patience. And the reason for that is, I already got encouraged into a corner where we're giving this forecast in May instead of in October. So we just want to stick to the comprehensive and consolidated forecast.
Thank you.
Thank you.
Balakrishna, please rejoin the queue for more questions. Next question comes from the line of Anil Kataria, an individual investor. Please go ahead.
Yeah, good evening. Yeah, most of my questions have been answered. I have only one question. This is regarding the MPS has been very liberal from investor's point of view, because that's fantastic dividend outgo. One thing is to improve the liquidity in the counter. Can MPS consider in the near future the stock split? So that will improve liquidity as well as the value creation for the stocks first.
Great. Thank you for the suggestion. I'll definitely take that back to the board and we'll talk about it. Thank you for the suggestion.
Mr. Kataria, do you have any more questions?
No, it's okay. Fine.
Thank you. Next question comes from the line of Saket Saurabh, an individual investor. Please go ahead.
Yeah, hi. Thanks for the opportunity. So I have two questions to Rahul. So one is, we are currently at around 550 crores of annual revenue, and there is high reliance on inorganic play to for revenue growth. So is there a critical mass or critical revenue beyond which you would say that it's the organic growth that will lead the overall company's growth? So is it like at 1,000 crore or at 1,500 crore, we can say that now as a technology plus service company, we are well placed to drive the company forward, because right now maybe inorganic is helping us plug those capability gaps or maybe help that critical mass which helps in delivering our project. So that's my first question.
Yeah, I think so. It's a tough one. I think on FY2024 we definitely missed a beat for two reasons. One was the whole thing that we discussed in the previous question around e-learning, and the second piece was on the education side. On the content side, we didn't have the momentum that we'd hoped for. That changes in FY25. Both the education business as well as the corporate learning business are poised to grow. The scholarly business is already carrying forward that momentum for a couple of years now. So from my perspective, I'd potentially like to wait to see how FY25 plays out with all lines of business performing the way they're supposed to. And maybe this is a question to talk about the same time next year when we've had the opportunity to look back. But at this point, I think the data set is too limited for us to take any judgment call. I think I'd like to wait for another year to answer that kind of question.
I appreciate your response. Now, second question is, out of say 550 crore, how much would we say annuity or subscription kind of revenue where there is a greater visibility, and how much would we say one time or maybe like projects like the one that got delayed? So is there a mix, or is it like across these three segments that we call out, content, platform, or e-learning? Is there a thumb rule that maybe segment one is more annuity based, greater visibility, and the e-learning is more a one-time project-based kind of offering? So is there a mix that we as investors can look up to, so that it gives us some visibility that, okay, the 60% revenue is what likely gets repeated, and 40% is where it requires repeated sales effort, or these are one-time in nature?
So I'll give you the big highlight and then break it down. So the part of our business that is kind of has a higher proportion of project-based revenue is the e-learning business. Roughly in FY25, that's going to significantly drop as we integrate AJE in. So e-learning will probably be less than 10% of our revenue in FY25, and 90% of our revenue will be between content and platforms. And it's got less to do with e-learning. It's more to do with the big acquisition that we've done of AJE. And therefore, you'll see a different proportion of recurring revenue. So that's at a high level. In terms of if I had to rank them, platform would have the highest recurring revenue, upwards of 90%. Content would also have a high recurring revenue, simply because even though it's services and not subscriptions, it's just it's old relationships. So again, it would be above 90%. So platform would be above 95, content would be above 90, and even within e-learning, it would be around the 80% mark. But overall, the proportion of e-learning is reducing in FY25, and so that changes as well.
Thank you. Mr. Saurabh, please rejoin the queue for more questions. Next question comes from the line of Karan, an individual investor. Please go ahead.
Yes, I have one question here. So Rahul, you said in the previous calls that we have one more acquisition planned, I think later this year. So are you comfortable in sharing the size, or maybe what kind of the size of the acquisition that we are looking to acquire, and is there any need of debt for that, or we will do through internal accruals only?
Yeah, I think it's so far out that maybe let's talk in a couple of quarters about that opportunity. It's too far out. Obviously I have what you're asking, but would like to wait for a couple of quarters to answer the question.
Okay, thanks.
Thank you. Next question comes from the line of Mahesh, an individual investor. Please go ahead.
Rahul, my question is on your FY25 PAT guidance. The guidance, is it conservative because FY24 PAT had a deferred order of 40 crores? If FY25 has a normal year for your experience center business, are you underguiding in terms of PAT?
Again, thank you for your observation. But that's the thing, right? If I have to give the guidance in May instead of October, I'm going to get more conservative, and that's what it is.
Okay, so there's your guidance.
Yeah, correct. So again, it's a balance, right? So if I think a lot of the community wanted us to give guidance sooner, so we're giving it sooner. But of course, when you give a guidance earlier, then it's not as tight. So yeah, there's definitely a level of conservatism in that guidance, for sure. And I have to be at this point because there's so much happening in the world that you want, ideally in this environment, you want to give conservative guidance.
Okay, that's fine. My second question is a specific question on Curie. Correct me if I'm wrong, Curie is based on GPT-3. So how updated or outdated is Curie, and what are the plans to upgrade Curie both from a text and a features perspective?
Yeah, Curie is working out its own proprietary model. So in terms of updation, there's a full engineering team that is working on this, and yeah. So I it's not linked. It's it's organic. It's been built organically.
Thank you. Mr. Mahesh, please rejoin the queue for more questions. The next question comes from the line of Arjun Balakrishna, an individual investor. Please go ahead.
Yeah, thanks. So around the other question I had was, do we have any divesting strategy? We talk about acquisitions, but in the long run, would be considering something like that? And how is Q1 looking? I'll put both in one question.
Could you say this last second again? I missed the second comment.
The second part was, how is the Q1 looking?
Thank you for the question. So I feel very uncomfortable giving quarterly guidance. I already feel very uncomfortable giving FY25 guidance, but I've been encouraged by everybody, so doing it for the first time. On divestment, I think we've done 10 acquisitions. All of them, on average, have been successful. I think it's too small as a company right now to be thinking about divestment. 5 years from now, does that change? Possibly. But at this point, I think everything is so tightly integrated, and it's difficult to think about that. I don't think you have the scale to even consider that at this point. 5 years down, maybe. I don't know. That's a very, very long-term question.
Okay, thank you.
Thank you.
Thank you. The next question comes from the line of Vikas Mistry from Moonshot Ventures. Please go ahead.
Rahul, I have a couple of questions. The first thing, I think I have heard right that you said that on AG side we have done rationalization to the cost to the tune of roughly 12 million. Is it right?
Correct. Annual.
Okay. The annual revenue is 200 crore. Out of that, you tend to say that you rationalize 12 million. So the overall reduction in the total cost on that base, can you ascertain that also?
Yeah, I feel uncomfortable talking about annual revenues because this is a new market we've entered into. A lot of competition we don't know. So in terms of annual operating expenses, we've been able to cut $12 million.
That looks like over 200. Last time when we talked, you said that the total revenue from this AG is roughly 200 crores out of it, and you said you are now saying that around 80 crores of it.
It's a loss. It was a loss-making company that we are fixing.
No, at EBITDA level, you said that it is a single-digit margin or the early teens it is.
I'm not sure where you're getting that from. We acquired a loss-making company, and in March 2024, we have consolidated losses into the total income statement.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Rahul Arora for closing comments.
Thank you for your active participation. Always appreciate it. We always learn more. We appreciate all your thoughtful questions. Your unique outside-in perspective helps us to learn and improve. We got many suggestions today, for example. I want to thank you for all your continued support and respect. Our journey together has been remarkable, and we have tremendous opportunity to make it even better. I look forward to your continued support, feedback, and partnership mindset. Thank you so much.
Thank you. On behalf of MPS Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.